You got to be flipping my flapjacks. My biggest fear for this stock market is coming true. Everything is playing out exactly how it needs to be played out perfectly. It's unbelievable. And so I got to share at the top of this video what's going on here, what it means for where this market's headed from here, and all those sorts of things. So we'll talk about that at the beginning of this video. By the way, I appreciate everybody joining me here today. I hope you guys are having a tremendous day out there. S&P 500 has some big gainers today. I just want to touch on a couple of these stocks real quick and what's going on there. Adobe came out with earnings. We'll discuss quickly what they reported and kind of my feelings on this. I'll also share my bull case, base case, and bear case for Adobe stock in this video here today. Then I'm looking forward to reacting to this video, consumer prices in the economy, all those sorts of things. Look at this. They got Rick Santelli and Steve Leisman this close to each other. Like, I just want to watch this because I want to see if they get in a fight. Like, these two guys, whew, like sometimes it could come across that they got bad blood for each other. So that's going to be a fun one to watch. Lloyd Blankfein, I haven't seen him in a minute. He used to be the big dog at Goldman Sachs. He's talking about where he sees the market going, the economy, all those sorts of things. I'm looking really forward to hearing Lloyd Blankfein. Like, literally, he's probably, I would say, of people in the banking space, the financial space of the past 20 years, he's definitely top 5 of the most respected out there. One of the best CEOs for the big dogs in the financial space. I would put Jamie Dimon ahead of him, but he's certainly very important. So I'm looking forward to sharing my opinions and perspectives on this video. Okay, appreciate y'all for joining me. One thing only I need from you. If you haven't already done so, please hit the like button on this video. That's all I need for you to do. And for everybody that's already smashed that like button, I appreciate y'all. Y'all are my heroes. Additionally, if you want to be subscribed here to the channel, you can certainly subscribe. We are now over, how many subscribers? 108,000? Somewhere around there. Appreciate y'all for being here. Additionally, I got 2 free resources for you guys here today. One is, if you're looking for my portfolio management checklist, that should be very helpful for you. I'll put that as a pinned comment down there. I can send that over via email, or if you want to text over, can do that. And then also my How Much Money You Need to Retire workshop. That's a really good workshop. I think a lot of you guys will enjoy it. It's a free resource. If you want access to that, can send that over. I'll put that as the second pinned comment down there. So you might want to grab both the resources. They're free. Okay. Alrighty, guys. So let's get rolling here. It's my biggest fear for this market, and it's all coming true. What's happening? Well, if you've been watching me religiously for this year at least, right? You don't have to be a subscriber since 2016 like some of you guys are, 2017 or 2018, 2019. If you've been watching me this year, I constantly brought things back to, man, this year is so similar to what year? 2018. Everything is playing out exactly how it should here. We're blowing through new all-time high after new all-time high. This is a year to date for the S&P 500 in the Qs. And why don't you have a little peek at this? It is exactly at all-time highs. Qs are now up about 14.5% for the year. S&P 500 up 12.2%. We're running right into rate cuts. But if you know my fear around the market, it's kind of been that essentially we would run right through rate cuts, and then very, very shortly after rate cuts, within probably a week or two of rate cuts, you could actually see the market actually go through a pretty significant kind of downtrend, right? Now, we saw in 2018 a lot of volatility in the market. And basically in 2018, early in the year, just like this year, we had a lot of early year volatility in the market. A lot of early year, February, kind of all the way through April, right? Which is exactly what we had this year. Now, in 2018, it wasn't as rough as it was this year. This year was way more dramatic as far as volatility in the market falling, right, with the whole tariff drama and all that, right, Liberation Day, as they called it. Now, the fascinating thing is here, with this potential fall that we could have this fall, and once again, this isn't guaranteed, but everything's playing out exactly how it should play out here, which is creepy. And I'm looking and I'm like, everybody's expecting a massive downfall in the fall time like we had in 2018. If we were to have that, actually, no one's really even talking about 2018 for the most part. But, if they are, I think a lot of people would expect a big downturn. It's possible we could get an inverse 2018, where essentially the most dramatic downfalls already happened. And yes, we do get the market to fall in the fall time, but it's not a dramatic downward move. It's not like, off a cliff like it was in 2018. Like, I remind you guys, we were We were deep into December. I think it was just as of December 21st, 2018, from what I remember. We were on pace for the worst December since the Great Depression for the stock market. It was brutal, man. I was getting tore up. I was like, oh my gosh, it was stocks falling 20, 30, 40% all over that market. And it was like quick. And if you weren't in the financial markets, you're like, what even happened? Like, it wasn't like the economy like crashed. It wasn't like anything crazy happened. At that time, there was worries about the Fed, being kind of stuck in their ways, not lowering enough, and they did start to lower in 2019. There was also worries about a little bit about the state of the economy, but that was like more of a minor worry. There was also worries about tariffs, which is something we certainly have going on, right? And do understand the Supreme Court's going to decide in likely the fall time what is going to happen with tariffs. Are those extreme levels of Trump tariffs going to be blocked or not? So the moral of this story is here, folks. The moral of this story, ladies and gentlemen, is it is extremely possible we're going to have a 2018 play out. But like I said, it's possible it could be an inverse where it's a down cycle where maybe the S&P 500 goes down 8 to 12%, but not more than that. And it doesn't do like a 20% drop like it did in 2018 or like it did earlier this year. It's very possible that could be what plays out. So what I'm going to likely end up doing is if I'm going to put any hedges on, I'm going to get them on probably the last 2 weeks of September. A lot of times I'll wait till, later in the fall time to like do my hedges, right? Maybe even wait till like December. I think this year, especially if this market just drifts higher over this next 3 weeks, I think I'm going to put on my hedges early. Get them in there and we'll see what happens. It might be fireworks. We'll see, okay? So, yeah, interesting times, right? And other than that, obviously I do my weekly buys. I'll be doing my weekly buys tomorrow in the public account, my Patreon portfolio, and my private portfolios. You know what I'm going to do next Friday? Buy in my Patreon portfolio, the public account, and in my private portfolios. I do that every single Friday, okay? Now, I want to talk about a few stocks quickly here that were some huge moves today. Warner Brothers and Paramount made a massive move. One was up 29%, the other was up 15%. So they're supposed to be combining together here. It has Larry Ellison supposed to supposedly be involved with this, who has basically an unlimited bankroll. So there was actually worries around Netflix today that they could form like a serious competitive threat to Netflix. If Larry Ellison's back in it, it's just an unfair advantage. So we'll see. We'll see what happens with all that. But that's what was kind of going on there, right? Synopsys, that was a huge move, but that was down massively yesterday, so it was just a big bounce back. Micron caught my eye. That one was up 7.4% here today. And the reason being, I don't know how many of you guys follow Micron, ticker symbol MU, but this is a company that's just in the perfect spot. And the reason being is their memory is needed in a massive way. And with how complicated these chips and how the need for memory is very bullish for Micron for the next few years. Now, when this chip cycle slows down in a major way and comes to a grinding halt, maybe in 2-3 years from now, it's not going to be good for Micron stock price. But for right now, it is a party. It's a party. And the party's going to likely keep going on for at least, I would say, 6 to 18 months here in regards to MU, right? Now, by the way, Micron's not a company I really like for the long term because they kind of go through, it's a cyclical company. Like 1 minute they're able to get unbelievable pricing for their memory. The next minute it's like, they're having trouble making profits. Like it's so up and down with them. But basically Citi upgraded them and they said Citi said they expect much stronger expected guidance on data center demand. We expect the company to report inline results and guide well above consensus driven by higher DRAM and NAND sales and pricing. We believe the continued memory upturn is being driven by limited production and better than expected demand, particularly in the data center market, 55% of Micron's revenue there. Okay, they believe DRAM upturn is intact, and our checks indicate demand for the AI sector increases sharply. And the bottom line is, like, Micron's just in the perfect place. And, I have a friend that's a big shareholder at Micron. And you know what I told him in regards to Micron stock? I told him this like probably a month ago or a few months ago. I said, if there's ever a time for Micron to go 200 plus, it's in this next 6 to 12 months. Like, this is the time to make it happen. Like Micron stock always trades at like dirt cheap valuations, but if there's ever a time this baby goes 200, it needs to be in this next 6 to 12 months because this is just everything you could possibly imagine is going perfect for them. NVIDIA's revenues are still blowing up. AMD is about to accelerate growth in a massive way, right? We know all the companies like the Broadcom's revenues are skyrocketing and are expected to continue to. So it's just the perfect storm for Micron. And so the numbers Micron's going to post over this next 1 or 2 years, it's going to be pretty shocking. Their net income, their revenue growth is going to be outstanding. But once again, keep in mind, Micron stock will peak way before the cycle peaks because people will already be pricing in the downside. It's part of the cycle, which is never fun because basically Micron gets squeezed in regards to pricing. It's brutal. Okay, so Adobe here, they came out with their earnings just about less than an hour ago. Earnings per share $5.31 versus $5.18, so nice beat there. Revenue $5.99 billion versus $5.91 billion, slight beat there. You know, Adobe is not a company that you would ever expect to just like crush it. Like, oh my gosh, can you believe how much they beat by? They're kind of more of a Microsoft type company, where like Microsoft, you're like, yeah, they beat earnings, but it's not like an NVIDIA or a chip company or something like you just never saw coming. Because their revenues are very steady, they have a lot of monthly and annual recurring revenue. So it's just a much more predictable business model, but there's not like that excitement of like, oh my gosh, Adobe reported $7 of EPS when $5.91 was expected, right? Meta is a company that can just blow your socks off. Shopify is a company, even to a certain extent, that could knock your socks off. Revenue increased 11%. It's a nice increase year over year. From $5.41 billion a year earlier, Adobe said in a statement. Net income rose to $1.77 billion, or $4.18 a share, from $1.68 billion and $3.76 a share. For the fourth quarter, the company says earnings per share will be $5.35 to $5.40, so we can call it about $5.37 midpoint there, $5.38 midpoint. Top and analyst estimates of $5.31. Nice. Adobe's guidance for revenue came at $6.08 billion to $6.13 billion, so we can call it like $6.1 billion basically. Analysts were at $6.08 billion, so slight beat there. That's just a game of Wall Street, right? Perfect. I mean, you know, I don't know what else to say. I graded the income statement. It was an A- income statement. I graded it. I put it in the private stock group. Like, it's good. It's really good. You know, like, all Adobe has to keep doing here is just come through with numbers. Like they're coming through. Just come in, beat your numbers. At the end of the day, this notion of like Adobe is going to be, you know, like, irrelevant. They're going to make it irrelevant. Like it's, you know, AI is taking over. Like no one's going to have Adobe anymore. Adobe products. It's just ridiculous. It's just ridiculous. And Adobe hasn't even really begun to see the positive effects of AI yet. I think that's really a story that will play out 26, 27, 28, and 2030s. So right now, this is really just their core business, increasing revenue 11% year over year. Like that's great. Just keep executing, man. Cheap stock. It's going to be a Google type situation where, you know, stock will get moving and then next thing you know, it'll be up 50% quick and I'll be like, whoa, how did Adobe just move 50%? Like, oh my gosh. Here's my bull case, base case, and bear case for Adobe stock. So what do you notice when you see my bull case? Something should stick out at you. It should be that revenue growth. Under my bull case assumption, I have revenue only going up 10% a year. Why does that matter? Because they just grew revenue 11%. So I have my bull case being less than what they just grew revenue. And remember, they haven't even really seen any positive effects of AI yet from the revenue standpoint, right? I have net income increasing 12% per year on average. A 25 to 30p is pretty fair for a company growing, you know, very low double digits revenue and net income. And for a company that has recurring revenue like obviously Adobe does. And that gives me a basically compounded annual growth rate of 21% on the low end, 26% on the high end. I'm taking that. My base case is so conservative. Look at this. I have their revenue only going up 8% per year the next 4 years. It's nothing. 10% net income's up, 37% net income margins, right? So a little increase versus where they're at right now. 23 to 28p ratio is extremely fair for a recurring revenue business model growing 8% top line, 10% bottom line. That puts the stock somewhere between $633 and $771 come 2029. Gives me a compounding annual growth rate somewhere between 16 and 22%. We can call it, 19% midpoint. Beautiful. Like, how? Free money. Do you like free money or not? Adobe's just like, free money, here you go. right? In my bear case, I have only grown revenue 2%, like they got disrupted or something, right? And then I basically make no money in the stock. So the moral of the story is here, Adobe is a buy. Alrighty, let's react to Rick Santelli and Steve Leisman and see if they get in a fight.
Or Steve?
Up 0.4% versus an estimate of 0.3%. Real earnings minus 0.1%. Obviously, the inflation number's taking that off. Let's see what we got here. Year over year, headline 2.9%, right in line. Ex-food and energy 3.1%, right in line. No adjustment to the prior number. But the one thing is the headline. The core at 0.3 is exactly in line with estimates. Let's see what else we have here. Unadjusted. That's all I have right now, Joe. How's food was up 0.5%, so some pressure there. Food 0.4%, owner's equivalent rent 0.4. A little bit of pressure right there. I don't have the actual table yet, but I'll get that in a second. Taking a look, see if the bond market is reacting at all. That's what Rick would be telling us, but he's going to be here in a second. I still have the 2-year at 351. Rick, you remember where it was going in? I can't remember. 10-year at 4.01. So that's actually down a bit on this number. Yeah, pretty big decline. I think market's seeing essentially, Joe, this inflation numbers in line with expectations. Okay. The key here, and I'll dig into the numbers, I expect to find tariff inflation in there. The key all along, the main risk to all of this was it going to spread to other things? That does not appear to be the case. That was the risk that held the Fed back. We can argue, did it make sense for the Fed to guard against that kind of risk?
Is this a big moment, Rick? Is that
263,000? Is that what I'm seeing on initial jobless claims?
I didn't see that, Rick.
Yeah, 263,000. That is the news of the morning. We haven't been above 250,000 since October of 24. So 260,000, where's that going to comp to? It equals where we were in June of 23. To find a higher number, you're back to October of 21. To me, that's the biggie. We're talking about, is the Fed fund futures market going to potentially price in 50? That is your catalyst to actually get there.
To price in 50. Where's the 10-year, Steve? I was thinking we might get a 3 handle.
10-year coming up. 4. That's what the market's reacting to.
Exactly 4.
Not the inflation number.
Exactly 4.
We're waiting for that under 4 number. Your buddies in Chicago, who have the calls on that part, right?
On the 4th of April, when we had our 3.99 yield close, the low close for the year for 10s in Chicago, everybody was betting that we were going to spend a lot more time under 4%. I took the other side of that. I think debt and deficits matter. I think the yield curves matters. So I still say, even if we close, and it's based on a close, and a weekly close is your highest priority from a technical perspective. And once we get that, I think if I was a trader, I'd probably still end up fading it. I think if the Fed cuts 50, the yield curve steepens 25. I still think 10s are going to be there, and they're going to be stubborn. It makes me upset when I see everybody talking about 30-year bonds. 30-year bonds haven't been the biggie in over 20 years. And just because the UK and the Japanese, they trade those things by appointment, it gets distorted. Arbitrage keeps it in line. But you want to watch the 30s versus 10s spread, 5s versus 10s, the fight, the knob, because the steeper these get historically, the more that tells me that the premium in between these maturities is going to keep getting wider and wider.
Rick, I want to just cut you off for a second because I want everybody to take a bit of a chill pill here on this jobless claims number. I'm trying to run it down. There was a spike of 15,000 in Texas, and I don't know why that is. It could have been some kind of special sort of thing it could have been in local education or something like that. But if you back that out, it looks a little less drastic.
Traders don't like backing anything out of the garage. They look at everything in there, whether you have jalopies or limousines. It is what it is. These numbers have never been accurate, and I think that they're going to pay a lot more attention.
That's what I was going to ask. These numbers, the revisions that we've seen, how much attention do you pay to this the first go-around?
Exactly. Like, in all seriousness, how much can you even trust these numbers? Like, maybe they're a little better than this. Maybe they're way worse than this. Like, it's sad, but I mean, there's such a distrust in any of these numbers. I mean, the thing you got to understand, this distrust around these government numbers is not new. I remember just getting in the financial markets, and that was back in like 08, 09. And I remember my dad, even back then, he said, "Oh, you can't believe any of that government data they feed you." Like, that was him, what was that, 17 years ago, 16 years ago or whatever, right? And he wasn't even the person that was like into the market, and he already had that view. So just understand there's been a distrust around government numbers and data for a long time, way before 2025, okay, for my youngins out there.
Treasury Secretary really kind of nailed it, and it made me a little nervous because basically he said it's not about maybe tweaking how we do the numbers. It's now becoming a case for how do we need to reform the Fed, and his logic is almost very hard to refute. If they're data dependent and the data is horrible, then maybe we do owe the markets more of a cut. I'm still an inflation hawk, but to see these numbers, especially on the producer side with no pass-through, I think a 50 is almost called for. And believe me, I'm not in the camp. Listen, I'm not going.
Rick Santelli saying a 50's called for? Whoa. I was not expecting that big of a statement. I understand probably a lot of people watching this video right now is like, what's the big deal about this? This is a big deal. Rick Santelli calling for a 50? Saying that's warranted? Rick Santelli?
These numbers, especially on the producer side with no pass-through, I think a 50 is almost called for. And believe me, I'm not in the camp. Listen, I'm not going to be auditioning to be Fed chief, okay? So I'm not going to tell people, if the Fed needs to cut. I think with record prices and equities, I agreed with most of Jay Powell's logic, but I think things have changed dramatically. And that 911,000 revision, more than half of those jobs taken away, that really does change.
Did last month, was it CPI first, then PPI? This month, was it PPI, then CPI? So it was like that.
Yes.
So last month, PPI was great. CPI scared the hell out of everyone. This month, PPI was great, and CPI was in line.
CPI is okay, yeah.
I want to know what Lloyd Blankfein.
I just want to take the other side of Rick's trade here real quickly, which is...
You're sitting next to each other. Do not get into one of those. Actually, maybe I'd be good.
Hey, what did I say earlier?
Why not?
Whatever's best for ratings.
Well, I just don't want any fisticuffs. Okay, I do want
ratings.
You're right. Okay, go.
Very quickly before Lloyd, you have a GDP running at a tracking forecast of north of 3%. You have the stock market near all-time highs.
At all-time highs.
Or at all-time highs, at or near. I get that the Fed can come down because it's restrictive, and there is not necessarily a reason to remain restrictive. There we go, a big bump, by the way, in the probability of the second cut, more confidence in the third cut this year. Wow. And I'm good with that. The question becomes, how far down should it go? How far from neutral is the Fed? It's because there's a huge debate.
Who the heck knows what neutral is?
Let me finish, Rick. There's a huge debate about what the right break-even rate is for this job market, given what's happened to immigration. We may be very close to that number.
If they let those guys go long enough, they'll get in a fight eventually. It's just due to happen. You just know it's due to happen. The moral of the story is, in all seriousness, in regards to what this means for the market, is market's going to be more excited than ever about a lot of rate cuts coming. That just is what it is. Now, the problem I think we're getting into here is, if you're cutting rates, if you're starting to say, okay, we got a lot of rate cuts coming, it's kind of scary in a way, because that could mean you're really, really, really actually legitimately fearful about the state of the economy and where this economy is headed. So that's something you got to factor in. People assume like, oh, rate cuts mean great things. Not always. I mean, heck, they cut rates like crazy in 08, 09. I think they started the rate cuts in 07, I want to say. But they were cutting like insane in 08 and into the beginning of 09, right? All the way down to zero. Did that mean good things for the stock market? No, the stock market still went down 50% from peak to trough. Did that mean good things for the economy? No, the economy was in shambles. We had like a 10% unemployment rate. It was ugly out there. I was so thankful to just be able to get a job at Einstein Bagels making $7.50 an hour, and then be able to upgrade my job to $8.25 working at Walgreens at 18, 19 years old. Like, I was thankful. Like, oh my gosh, it's hard to get a job out there right now, right? So yeah, when people start being thankful for a job at Domino's, you'll know you're in a bad economy, essentially, okay? Next one up here, former Goldman Sachs CEO Lloyd Blankfein. I'm looking so forward to watching this one.
This is quite a morning because there's a lot of things that we've been talking about. Charlie Kirk, 9/11.
No, it's kind of, I don't want the whole conversation to be so sober, but it's a sober moment to reflect on. And of course, I was downtown all day, worked downtown, and every night on TV, these lawyers run these ads for people who got diseases from breathing in that stuff. Of course, I had lymphoma, so I always get reminded when I watch late night TV of the consequences of working alongside the World Trade Center that day and for months afterwards.
I didn't connect those two, but yes, you did. And you're better than ever, but I remember, and you can't say for sure, but why wouldn't you at least think there's some linkage there?
Well, people who weren't downtown get it, and people who were downtown don't get it, so you never know, but it's an environmental thing. And so every time I see one of those ads for people to join some class action or something, I think, I don't do it, but I think about the consequences of that day.
What do you think about it on a more...
Yeah, I don't think Lloyd Blankfein needs to get in a class action. I mean, that man's got a few dollars to his name. I think he's doing all right.
This, meaning we're 24 years later. And to the extent that there's generations of people who may not even understand it or know it, what took place that day?
I think of, circle of life, Simba. Life goes on, and people were too young to remember it. And I was born, after World, people were in World War II. Did I live through World War II? The other day I was talking to somebody, and they were reflecting, and they said that their nephew didn't know enough about Vietnam. And I said, well, he was born further from Vietnam than you were from World War I. And so it's just the nature of things. And, it's good. It's part of the charm of life. You don't get overly saddled with the consequence, with things that just came from the past, and we can look forward as we're going to do this morning.
Okay, so let's do that right now,
yes.
Which is, I always think of you as someone who thinks about risk, as a risk manager. So where are we today in America in terms of our economy, in terms of all of the different cross currents? We got tariffs, we've got issues about the Federal Reserve and what they're going to do or not do. We've got questions about the independence.
Yes,
geopolitics.
We certainly have a wall.
What does the risk manager that is Lloyd Blankfein say about all this?
We have a wall of worry, and look, we're about to lower interest rates into a bull market. So I would say the setup for the markets is pretty benign, and we can go over a lot of details, but everybody else, talks about that. And then you have to worry about a lot of things that could go wrong, which, I always lived life, spent 99% in the 1% of the things that could go wrong. So explains a lot of my unhappiness all the time. But the way but people are hard pressed to come up with it. People don't see a lot of leverage, and they don't see this and they don't see that. The way I used to try to draw people out is I never used to say what could go wrong. I'd say, you just, you were swimming in the Arctic, you got frozen in an ice floe, you melted down, and a year later, I'm telling you the market crashed. Tell me what happened. And then people could come out and say the likeliest things that probably could have happened. And it usually involves around leverage in this time now, probably credit, leverage in places that you don't see it. And, there's certain environmental hazards that are here. And then I used to think to myself, if I could think of it, that's probably the last thing that would happen. But I look at credit spreads being so narrow, so much money going to private credit, people trying to, goose their returns a little bit by leveraging up in kind of odd ways, at the portfolio level or other levels.
Right.
And so, leverage starts to think in. I think of the places where this is being done. A lot of these assets are being put into insurance companies where people are people kind of assured because the long term, they're investing premia for longer term liabilities. But if I were an insurance regulator at some point, I might say, are those assets really worth what you say they're worth? And are they going to come? Is it going to come to pass that you'll have the money to pay your liabilities? And let's look at that and let's mark them and let's take. There are a lot of things like that I would be going out and we'd going around the table, and then somebody would say, well, I don't think this or that, and I'd say, well, I don't care what you think. Just tell me what might happen.
But do you say to yourself, though, these are sort of 1% risks, and otherwise, as you said, we're in this benign environment?
So what he just said there is really important, not for actually what he's talking about, thinking about the market, because market crashes, corrections, blah, blah, blah. It's going to happen, and a lot of times you won't see it coming, and that's fine. But the way what he just took you through is extremely important for every single person watching this video right now. For what? For stock picking. That's how you need to be. Before you ever put $1 in a stock, you got to be thinking about all the things that could go wrong with this investment. And that's such an important point. And I even actually made this point to my private stock group members recently. I said, hey, I see a lot of you guys run bull cases on stocks. And some of you guys run bull and bull and base, but I'm not seeing enough bear cases. You got to run your bear cases for your stocks too. When I do my Adobe numbers and every other stock I run numbers on, right? I run my bull case, I run my base case, and I run my bear case, and I run them all a little more conservative too, which is also very important to do. You don't want to be, too aggressive with your numbers. But if you're not running a bear case scenario, thinking about what could go wrong, all the things that could go wrong, you're playing this game wrong.
I think you're saying is a bullish environment and continues apace, or do you say
there's a lot of 1% risk, but it's not a 1% risk that something bad will happen. It always look. We had, the crisis of the century roughly every 4 or 5 years. Debt crisis, emerging debt crisis in 1994, big crisis 1998, long-term capital and the Russia debt default. .com bubble, 2000, 2001, 2007.
We're quick learners?
We're kind of, well...
Or are you saying we're due?
I'm saying we're due. And it doesn't matter that you can't see from where it's coming from. Now, having said that, the other thing I used to ask people all the time is, you sound so much smarter when you're bearish. Then I used to say, what do you think? And then I said, what are you? How are you positioned? And, I have all these bearish thoughts, but I'm 100% in equities.
Personally, right now, you are.
Yeah, because because we're about to lower interest rates into a bull market. Anything having to do, there's anything having, people who can't spell AI, but will buy anything that's associated with it. People think it's it's an epic moment.
And do you think it's an epic moment? Is the trader that is Lloyd Blankfein buying all of the mag set? Like, when you say you're 100% in equities, what does the portfolio look like?
I think it's a phenomenal moment. It might be. I'm not a great technologist, and I've lived through waves of technology, and I experienced things that changed the world, and I experienced things that changed our fortunes because we overinvested in stuff.
Lloyd, have you ever not been 100% in equities? Was there ever a time where you thought, okay, this is getting scary, I'm going to take some money?
And let me ask the corollary to that, because we go back a ways, and we've been in different forums. We've listened to you and off-the-record things in foreign countries, that have a lot of skiers and stuff that we cannot talk about. But we've talked. You have always had a lot of things that concerned you, and you say it's 1%, and you're a risk guy. I just want to know, and answer Becky's question too. On a scale 1 to 10, you're always worried about all these things. Is it more or less right now than normal? Because that's the only way as a risk guy. And you've always been able to stay 100% invested, even though you're always.
Well, listen, we had you divide the world into your outlook in 2 parts. What do you think is going to happen? What do you bet on? How do you position yourself? And then you get into risk management mode, where I don't care what anybody thinks.
You gotta love Becky, right? Becky just gets in there and asks a question. You're like, have you ever been not 100% in equities, right? Then Joe comes in, distracts him and goes on a 2-minute rant on blah, 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 blah.
And then you get into risk management mode, where I don't care what anybody thinks. Just what could possibly go wrong? Let's look around the corners.
That's when you're managing for a firm.
Right. Well, I think about that.
Versus what you're doing.
So the answer is, I think the investing market is all tailwind, except it can't possibly be. So I have to work. I have to work to find. I work to find things. But that's the nature of my. That's the nature of my life.
I think when you were managing other people's money, you were probably more cautious with it than potentially your own. I mean, I'm just guessing. Or is there a time where you were ever not 100% involved in equities?
Oh, sure.
Yeah. There was a time when you took
yes,
off the table.
But I don't know if it correlated with what the reality. I used to. I'd say to people, if people looked, very happy and the world was benign, I'd say to people, I haven't felt this good since 2007. or I haven't felt this good since early 1994. I thought the birds were chirping and the sun was shining in those periods of time, and who knew?
But I guess that's what I would ask. Is there a time that you've ever taken money off?
She's going in for a three piece. She's going in. She's not letting this go. Good for her. I wish Becky would have just done this whole 9-minute conversation. It would have been more insightful.
Well,
yes. I
so
feel
what caused you to do that?
To answer your question, in the risk-taking side of things, I feel very, very good about things, and in fact, but kind of informs my sense of foreboding. Yeah. That I haven't felt this good since 2007,
right?
Or 1994.
But you don't know when it's going to come, so there's not a whole lot you can do about it.
Well, I think you have to protect the tail risks. I wanted to own lottery tickets, not write them.
Right.
And you start to look at, in times like this, I want to go around and I want to see, what's really susceptible. What could go, if something went wrong, what would the impact? And so you can move up the credit curve and you can move up the higher value curve, and I think that's not a bad thing to do now. And it happens to conform to my view of the market, because I think the most exciting companies, the fastest growth, usually size is the enemy of growth.
Right.
But here you have the biggest companies who are positioned to take advantage of the new technologies because they can afford to, have been the best ones to go in. But then you go, and other people are coming to the market today with companies that are the next level down, the next level down, next level down, and those are riskier.
Dang. He never answered the question properly like Becky was asking. Oh, well. Alrighty, guys. Appreciate you joining me. As always, thank you so much for being here. Once again, I got 2 free resources for you guys. First pinned comment down there will be my free portfolio management checklist. I think you guys should definitely enjoy that. And then the second free resource I have for you guys down there, that will be the second pinned comment, is this workshop on how much money you need to retire, thinking about, the money game and all those sorts of things. I think you guys will really enjoy that. Might even get a little inspiration from it. Alrighty, guys, much love and have a great day.